Hello everyone, welcome back to the Road to Retiring channel. I hope you're doing well. Today I wanted to speak about Warren Buffett and the Berkshire Hathaway portfolio he owns. Now this portfolio has had some incredible performance over the years. This letter released in 2021 shows the comparison between Berkshire's performance versus the S&P 500, and if we scroll down from 1965 down to 2021, we can see the compound annual gain for Berkshire Hathaway is 20.1% compared to 10.5% compound annual growth rate in the S&P 500, and the overall gain is an astounding 3.6 million for Berkshire Hathaway compared to 30,000 in the S&P 500. So the levels there are absolutely astonishing, and the top 5 holdings in Berkshire Hathaway portfolio that we're going to be discussing today are Apple, Bank of America, Chevron, Coca-Cola and American Express. And looking at the last 20 years, I do think it's important to mention that Berkshire Hathaway actually hasn't performed as strongly, so they may not all have the amazing outlook that the stocks in Berkshire Hathaway's portfolio have had in the past. If we look at the last 20 years, it's pretty much in line with the market. S&P 500 index trading at 10.3% annualized returns over the last 20 years, and for Berkshire Hathaway, this is at 10.1% over the last 20 years. So just because there was a lot of success in the past with Berkshire Hathaway stocks doesn't mean that there will be that same success in the future. But Warren Buffett is obviously a very intelligent investor, and let's hope that those 5 holdings that are the largest in his portfolio at the moment, let's hope some of those turn out to be fantastic investment decisions like his ones in the 70s and 80s did. And if we want to own one of those, I'm going to go over the buy values that we should be picking them up at. So starting off, I want to go to the metrics and I want to talk about Apple. Looking at Apple, we have to do it in lowercase for some reason, otherwise it doesn't work. There you go. They have great free cash flow which can pay off their long-term debt really quickly, and their EPS growth is fantastic, and their operational cash flow and revenue growth are also solid at around 5 and 6% respectively. The one thing that puts me off with Apple is the equity growth. Now the liabilities are catching up to the assets, and this equity is falling pretty much year on year with slight changes here and there, but at minus 6.52% each year the equity has been falling, and as I said, liabilities are catching up with assets, so it will be interesting to see if they ever do catch up, or potentially if liabilities overtakes assets, that's when people start to become really worried. So it'll be interesting to see how that develops. Now looking at the valuation for Apple, I'm going to go through things very quickly as I can't go into detail for all 5 stocks, otherwise the video will be far too long. We've gone for a 0.7% dividend yield, pretty much in line with how it's been historically. That slightly increased margin of safety because of that equity and where that might fall. Now the share dilution, we've gone for minus 3.5%. Apple have been buying back stock very aggressively, so I'm confident that they're going to continue this, and I've gone for minus 3.5% in the share dilution. Earnings growth, we've gone for 6% and a 22p multiple, which gives us a P fair value of $117 that we'll be looking at. Analysts are expecting 8% revenue growth, and the price to sales multiple historically the last 5 years has traded around that level at 5, and that would be an $119 fair value to pick it up at. And lastly, for cash flow, gone for 8%, slightly above earnings, and again a multiple which is pretty much in line with how Apple has traded historically over the last few years. So we've crossed those 3, gives us an average fair value of $119.10 for Apple at the level we should be looking at to potentially buy, and that's a 21% fall from the current levels. But if we were to keep things at the current levels to 2028, that would still be a 7.16% return based on these estimates each year, and with dividends that return each year jumps to 7.87%. So it's definitely still got some good returns, and then if you were to move out more and more years, then that return could potentially grow. We'll have to see how earnings and analyst estimates develop. Now I want to move on to Bank of America. Bank of America have a very interesting free cash flow report. You can see it's minus 6 billion right now. Now, I don't think this is something which is going to be consistent, because if we look at the current trailing 12 months, yes, it's at minus 6 billion, but they have minus 52 billion in change in working capital, and this is not something which is hopefully going to be super consistent. They gained 22 billion in their change in working capital in the last quarter, and if we look annually, they were gaining 13 billion in change in working capital in 2019. It's just started to become a really strong minus. But if, as I say, in quarterly, they've got 22 billion gain in change in working capital in the most recent quarter. So I think as long as the funds from operations don't drop off to levels like minus 6 billion, it's not as big a red flag as it first seems, and that could actually be free cash flow of around 40 billion if it wasn't for that change in working capital. Now, that 40 billion doesn't quite put us at the levels we'd like to see them pay off their long-term debt, and because of sort of slow revenue growth at only 2.6% and slow equity growth at 1.3%, we are going to have quite a high margin of safety with this, around the 25% mark. Now, based on these valuations, 2.25% earnings growth, and again, we've gone for multiples that are similar, so a 12 multiple. This gives us a fair value of 26.98, and we want to move that up to the analyst expectation at 3.36. Our fair value would jump up a little bit to 28.47, and if we were to put the P multiple up to 15 or 14, that's pretty much where it's trading at. But I feel more comfortable at levels like 12 and somewhere between the realistic growth rate and the half analyst, maybe around that 2.5 mark. That will give us a $27 fair value. Now, in terms of price to sales, again, there's not great revenue growth rate expected. Analysts only thinking there's going to be 2.65% revenue growth rate over the coming years. Not as high as we'd like to see, and because of this, it brings our fair value only to $23.73. And lastly, with the low earnings, we'd like to have the operating cash flow growth a little higher. I've gone for 45,000, but I've been really kind considering it's minus 6,000 right now. If we do see that change in working capital fall off, these are the levels we're probably expecting to see. And I've gone for an operating cash flow multiple of 7. Sector medians around that 7.5, so it could potentially be higher, maybe around 8. But I'd like to see it come down around 20%, I think, before I start to look at it strongly again, and that gives us a fair value of $26.11 for Bank of America. But it would be a 9.94% compound annual growth rate to our 2028 value at the current price. So again, by no means are things bleak with Bank of America. Chevron, on the other hand, the fair values really aren't good. They coming in at around 73.2%, and this is all because of minus 8% analyst estimated growth going each year. I've been kind, I've gone for minus 1%, but that's because a lot of that fall is expected to happen between 2022 and 2023, and I've gone for the 2023 estimate on this. If we have a look, 15.48 is what I've put in, and that's expected to fall from 18.83, which it was in 2022. So I've gone for the high dividend yield still at 3.5, which means we've reduced the discount rate, but with the standard P multiples around the levels it's been trading at, obviously the earnings are high right now, so this may move up a little bit, but even still we'd have to see it hit super high levels before it becomes something we'd be interested in, around the 18-19 P multiple levels. And the CVX, that's just not what's expected of their sector. If we look at their sector median, it's around the 6.8, 8.7. It's around that level at 8. Now the 5-year average, yes, is up at that 17.4 level, but for the sector median to be around the 8 level, I wouldn't feel confident going with a P multiple of 18, which is pretty much where it's trading at. Personally, I feel more comfortable at the levels of 8, and obviously this just isn't good. The fair values are poor. Minus 3.8% revenue growth is expected from 2023, and with a price of a cash flow multiple of 5, this gives us fair value average of $70 for Chevron, and even the 2028 price prediction, including dividends, only brings us to $130. So I'm hoping that the people that own Chevron are seeing something that I don't, and if you are one of those, I'd love to hear what your sort of reasoning behind owning it is. But it's not one that I'd feel comfortable buying personally. And as we can see on here, Warren Buffett has started to sell a little bit off. Only 1.44% change in shares, but he is starting to sell, and that's a minus 2.38 million share drop. He just has so much money that it's only 1.4%. Now moving on after Chevron, I want to look at Coca-Cola. Coca-Cola has a really solid dividend around the 3% mark, and it is expected to grow earnings. 6% is the analyst 5-year estimate, but the realistic growth rate is only falling in at that 3.29% mark, so I don't feel super comfortable going to those levels. But if we were to see those levels that the analysts are expecting at 6%, then that brings our fair value for price over earnings up to around $51.27. And for Coca-Cola, the P multiple does typically trade around that 24 level. We look here, it's currently at 24, their 5-year average is at 24, so I feel okay at that 24 level. And it's one that typically has that higher PE because everyone that buys things like the S&P 500 and ETFs, they obviously are buying Coca-Cola at the same time. So the Coca-Cola price to earnings usually stays quite strong. Now, even at that 6% mark, which I don't feel comfortable at, it's only a $51 fair value when it's trading at $59 right now, so I'd still like to see it come down a bit more. And where I'd feel really comfortable is around this $45 mark. Now, right now, based on that $45 average fair value, we're expecting an average 2028 price of $78.22, so that would still be a 5.65% compound annual growth rate from the current price. And if we include dividends in that estimate, that jumps to 8.65% annual return, which is pretty strong. And so Coca-Cola is definitely one I'm interested in and would like to own if it falls down to these levels where I'd feel a lot more comfortable around the $45 mark. So if we do see that, it's definitely one I'll be interested in. And lastly, but not least, American Express. American Express has an average fair value based on our estimates of $146.43. I've been quite nice with the earnings growth rate. I've left it up at the analyst 5-year estimate because our realistic growth rate is similar to this. But if we were to bring this down slightly to 6%, then the fair value for the price of earnings drops to around 140. For price over sales, we're seeing around that 150 fair value again. And for price over operating cash flow, if we go for, say, a 7.5% return on earnings and maybe a slightly increased operating cash flow growth rate at 9%, then we can see prices potentially move to around $147 fair value. And at these levels, you'd be seeing an 8.82% compound annual growth rate, including dividends, right now if you were to buy. But again, we'd like to see it come down a little bit so that compound annual growth rate is a little bit higher. So they're my valuations for the 5 stocks. I know that I haven't been able to go into great detail on any of these with any explanation behind it, but ranking them, we have Chevron 5th, right at the worst one by far. We need a 57% drop to become interested in it, and it's definitely just the 5-year analyst estimates really just messed us up a little bit. Following Chevron, the other 4 are all relatively similar. Apple's at minus 21%, but for me, it's the company I'd be most interested in owning. It's the one that I probably want to own more than the others, along with Coca-Cola. Those 2 are the ones that I want to own, so I'd love to see their prices fall a little bit so that I could get in there, being a bit selfish. And in terms of best value, it's actually American Express. There's only 17% fall needed for us to become interested in. Right now, best value one is probably American Express, but for me, all 5 of these are a little bit above the values that I would want to purchase them. So I'd be interested to know if you also are buying any of these right now and why you're doing that, including sort of what your outlook is and your justification for it. I'd love to go into a bit more detail on any of these, and if you do have any questions regarding any of the things I've spoken about today, let me know and I will get back to you in the comments. But for now, it's been Road to Retiring. I hope you enjoyed the video, and I'll see you in the next one. Bye.